This is very, very important, and you can only really understand it if you understand the psychology of bankers. Imagine that you're a director of a bank and you have got loans out to businesses in this environment, and you know that quite a number of the businesses which you have lent money to cannot handle higher interest rates because they are, we could be really blunt and say that they're zombie companies which you've been keeping going because you didn't want to write off your loans. They could be merely businesses which in better times thrive, but when they get a drop in sales, then immediately they start running into overdrafts. So when it comes to that sort of liquidity money, do you really want to provide liquidity into an economy which you can see is beginning to turn down because interest rates are going up? The answer is no. The other thing is that quite a lot of your activities, and particularly since the 1980s, have been increasing in the financial sphere. So you've got a lot of exposure to financial assets. Rising interest rates, what does it do to their values? So that's another area which you're probably going to try and cut back on. So this is a time to be very nervous. And if you were caught, let us say, with COVID, and of course, COVID completely unexpected. What happened? Everybody, their sales stopped, their costs continued, their borrowing increased. So, you suddenly find that you are over-leveraged in a market which suddenly is beginning to decline. Now that, for a banker, is a frightening position to be in. So what do you do as a director of the bank? You want to cut back as much as you can. And the thing that was interesting, and I can't remember whether this came up the last time we spoke, but Jamie Dimon, he said that 2 weeks ago, I likened the economy to being in a storm. I've upgraded that now. As far as I'm concerned, we are in a hurricane. Now that is the most senior commercial banker in the world, giving you a heads up that he is going to start contracting his balance sheet. Do not ignore that. And nor will all the cohort of bankers around the world. They will know exactly what he said. And if they hadn't already arrived at the same conclusion themselves, they have been told by Jamie Dimon that this situation is getting worse. Therefore, contract your balance sheets. It is inevitable. And this is the cycle of bank credit. We've had this ever since records really began. It was particularly violent in the first half of the 19th century. It smoothed out a bit after the 1844 Bank Charter Act, which was a major piece of legislation. Of course, this is the thing which led to the post-war slump. It led to the 1930s. This happens every 10 years on average. And we are now, 13, 14 years since the last slump, the last bank credit cycle downturn, which was essentially financial in nature, and that led to the Lehman failure. So, it's time we had another one, I'm afraid. And if you are a director of a bank, you will be very aware of all these dynamics, and you will feel very, very exposed. And furthermore, where you have counterparty risk to the Eurozone and the Japanese financial markets, you will know that your counterparties in those markets are even more highly leveraged than you are. It's an average of the G-SIB's average in the Eurozone is around about 20 times. The average in Japan is around about 21, 22 times. So, it's just incredible, the leverage in these foreign banks. And that's where the failure is likely to come from first. So what do you do? When it comes to everything, you just want to just batten down the hatches and to hell with it. If you're going to, just get your loans in as much as you can, cut your deposit base as much as you can, reduce that ratio of balance sheet assets to equity, and protect your shareholders.
Are we beginning to see in the actual data these deleveraging steps on behalf of the banks? Is that already beginning to appear in the data that you monitor?
It's only really evident in slowing down of the growth. I'm talking sort of worldwide rather than specifically. The slowing down in the growth of broad money supply, which is comprised basically of bank credit and everything which is slightly more liquid. So yes, we are seeing signs of it slowing down, but we haven't yet really got the signs that this is really going to crash. But I have no doubt that in my own mind that is the direction in which it's going.